Inflation in Singapore continues a downward trend into negative territory. Core inflation, which strips out the cost of homes and private transport, has fallen to minus 0.2% for March. Overall, inflation has flattened to zero. Now, economists warn the worst is yet to come as circuit breaker measures only took effect this month.
It is the second month that Singapore's core inflation has dipped into the negative. Headline inflation also fell to 0% compared to 0.3% the previous month. Last month, Singapore's central bank had forecast deflation at minus 1% to 0%. Economists say deflation is a sign of economic recession. Analysts at Citigroup also further revised their GDP forecast, saying it'll contract by 8.5% this year, down from an earlier estimate of a 6% decline. That's after taking into account the impact of a 2-month circuit breaker period. Analysts say a deep recession would mean a higher risk of retrenchment. One economist expects the circuit breaker period will hit the labour market hard. This in turn will further dampen consumer sentiment and demand.
We are looking at around 150 to 200,000 retrenchments. Even with the help that the government is providing, that would not be able to bolster consumer confidence. Even with lower consumer prices, the spending may not be there, as people want to save more during this uncertain period rather than spending on discretionary items.
Another economist says consumer spending habits will be more distinct in the months ahead.
We'll start to see a clearer split between whatever that is essential versus whatever that is more discretionary spending. So food inflation may still continue to support the overall inflation numbers, mainly due to supply side disruptions. But discretionary spending to remain subdued. Even after the circuit breaker measures, life wouldn't go back to normal immediately. It will be a very gradual pick up in activities.
Discretionary spending such as taxi and private hire vehicles and holiday travel have driven a bigger fall in the prices for services. Oil prices are expected to remain weak and is also weighing down on inflation. That's because energy-related components make up 10% of the CPI basket. Economists say deflationary pressures will last throughout the year, possibly bottoming out in the third quarter. They expect inflation to creep into the positive next year if COVID-19 can be eradicated.